welcome to, I believe, what is the first webinar of Junior Enterprises Europe ever. So that's quite exciting. And I'm also very excited to guide you through this workshop on the fundamentals of corporate finance. The attendants are from a very diverse background. I saw that earlier. So this is starting with the fundamentals. For some of you, this might be not extremely relevant anymore, but just so that everybody's on the same page, we'll definitely start, with just the principles of accounting and finance. The reason, I should also start with why I believe that I can actually talk about this kind of stuff. It's obvious that I'm not a 15-year veteran of the corporate finance industry or anything, but I was lucky enough to have, let's say, a diverse range of experiences from banking in Germany and M&A in Germany, studying corporate finance specifically in the US and tutoring it there as well. Then ship finance in Greece, FDI project management, and FDI stands for foreign direct investment project management in Sri Lanka. And now I work in transfer pricing with EY in Belgium with Ernst & Young. And so like I said, it's a good range of experiences, and that also is kind of good because I'm not highly specialized in one specific field, and instead I basically throughout my life used the general concepts, just applying that in different industries. And with that, I think we can already go ahead. I will now share my screen, and hopefully that works seamlessly. I will also start the presentation from here. One thing in advance, I would like it if you obviously ask questions. I mean, I will try to make it very interactive, but of course, with the number of people joining remotely, over 27 by now, it's not that easy. But nonetheless, if you have a question, please just unmute, ask a quick question real quick. I'll try to answer. And otherwise, if you have questions also at the end, no problem to answer those then. All right, what we'll talk about today is basically, we'll start with the financial statements, which hopefully all of you have seen already, but nonetheless, we'll go through that a little bit. We'll talk a bit about the cash flow versus profits. We'll also do a calculation of the cash flow from assets, which is a specific calculation. And then we'll talk about project or investment returns generally. And depending on the time, I will also touch base a bit on corporate valuations. All right, let's go ahead. So I will start with the income statement, and just to have some kind of relevance as well, I used a real income statement. This information is from yahoo.com and on Daimler, so the company that basically Mercedes. And so the first thing is obviously we'll start with the revenues, and that's any kind of income statement starts with the revenues.
Christian?
Yes.
Can you share your screen, please?
Oh, I thought I did that already.
No, we do not see it.
All right. Now?
Yes, perfect. Thank you.
Yeah. Okay. Sorry about that, and thanks for the hint. All right. So now that everybody can see what I'm seeing, okay, quick check, good. Basically, the revenues are always at the top, and then the expenses come up, and then we end up with the minor expenses at the bottom, taxes and stuff like that, and the resulting at the bottom is the net income. One thing is that I wanted to mention, or a few things that I want to mention here, is basically that it seems fairly obvious, but sometimes there are some questions that are hidden, and nobody kind of tends to ask these questions. For example, the cost of revenue, it's also called the cost of goods sold. For Daimler, it's very simple because, I mean, you have materials that you need to build a car. But software companies, it's already not that easy anymore. And that's also something that's interesting to know for people not in the accounting field. When people talk about accounting, sometimes the impression is that it's very black and white, very straightforward. That is actually quite far from the truth, because you can always kind of put the numbers into certain accounts, and obviously companies have done that, some often quite wrongly, and they have been convicted of crimes for that kind of stuff. Software companies, for example, when it comes to the cost of goods sold, can even put the employees who are directly involved in, for example, the implementation of software at the client. that kind of cost and HR cost, in effect, they can put into the cost of revenue, so the cost of goods sold. Then in addition, I wanted to mention that SGA generally includes depreciation, and depreciation is a very abnormal cost in this case, because when you talk about HR expenses or material expenses, it's a direct cost that flows out of the company. But depreciation, and it's a major cost as well for any company, it is not actually a cost that means that money flows out, because it's just a way for the company to kind of account for the loss of value of its assets. We'll talk about it in a more detailed example later. Another point that always tends to be forgotten, or sometimes tends to be forgotten, is that we will see interest expense as included in the income statement. But when we talk about the income statement, the repayment of loans, for example, is not mentioned here, because although here money flies or is paid out by the company, it's not actually an expense. It's just a repayment. And that repayment of loans we will see that later, will show up in the balance sheet. And then what is not mentioned here, but you can see that the income from continuing operations, which is here at the bottom, is not the same as the net income itself, and that's due to extraordinary items, which we will also talk about in a second. We also have the balance sheet. What the balance sheet does is basically, unlike the income sheet, where an income sheet shows throughout the year what has been done, the balance sheet is a snapshot of what happened on one specific day, and that's usually the 31st of December, because that's when, let's say, the fiscal year of 95% of all companies ends, so the accounting year. The asset side shows what the capital is used for and what it's invested in, so it's current assets or property or goodwill or intangible assets, whereas the liability side and the stockholder side shows the capital source. So where does the money come from? Is it from banks? Is it from people like you and me who invested? One thing that should be noticed is it's simply ordered in decreasing maturity. So anything that's current is usually at the top, and current means with a maturity of up to 1 year. So basically, an investment that matures in 3 months would be a current asset, or a debt that the company owes that needs to be paid in 3 months would be a current liability. All right, before I go down, one thing I noticed when I pulled out the balance sheet of Daimler is that you will see at the top of the liability side, total revenue. This position technically has nothing to do in the balance sheet. And I actually had to think about why it would be there. My only explanation is that you have here the position deferred revenues, which is empty. So my explanation of this, and it may as well not be entirely correct, and that's also where the art of accounting sometimes comes in. Basically, and we talked about accrual accounting, so accrual accounting basically means that whenever a revenue or a cost is incurred, that a cost or revenue has to be accounted for in that same period. For example, in this case, we have deferred revenues, or what they call here total revenue. That is a revenue that has been collected. In other words, a company has paid for a service, but Daimler has not, or for a good, sorry, Daimler has not yet given that good. Accordingly, it is a liability from the perspective of Daimler, because they have received money, but they still have to do the service or manufacture the good. And this could be, for example, when you have corporate clients who purchase Mercedes for their own fleet, and they have contracts over years. And the company, the customer of Daimler, already paid for, let's say, the next year upfront. So Daimler collected the revenue, but actually hasn't earned it. And so it's a liability for now. In the future, this deferred revenue or total revenue would be then changed into, once it's realized basically in the future, it would be changed into the normal revenue at the time. Then also one more aspect about financial ratios, and there are many of those. I will not go into too much detail because it's an art in itself. But for example, when we talk about the debt to equity ratio, which is an often cited ratio. It basically talks about the liabilities in relation to the stockholders' equity. And why I'm highlighting this is to show that things are not necessarily good or bad. For example, a debt to equity ratio of 3.3. Would you now say it's good, it's bad? From my perspective, and what people usually do is, the only thing that's compared that is compared to is either the industry or the historic development. So from 3.3, you basically gain zero information. But when you look at the industry, and the industry usually has a debt to equity ratio that is, for example, only 2, that means they have more equity, then 3.3 might be considered very risky because there's a lot of debt in the company. Whereas if last year Daimler had, for example, a debt ratio, or before 2016 in this case, had a debt ratio of maybe 4 even, that means they have improved, because 3.3 means that they have 3 times more as debt as equity, for example. So here, this is just to highlight that it's always subjective. It's not clear whether it's good or bad, but when compared to the industry, when compared to historic developments, that's where people can actually really extract information. And then one more item here on the side, goodwill. I'm not sure if all of you are familiar with the concept of goodwill, but this is highlighted because we'll talk about this in a second, and then it will become more clear. For example, and by the way, I don't hear from you at the moment, so I'm assuming so far no questions. So here let's talk about the book value versus market value, and that's related to extraordinary items as well as to goodwill. For example, what happens when a truck purchases when a company purchases a new truck, and it's usually across industries the same thing. If you just have a normal vehicle fleet, they depreciate the asset over 5 years. And that means, we talked about this, I mentioned this earlier, when you purchase a vehicle for 100,000 euro and you depreciate it over 5 years, that means you assume you use it for 5 years. And that's why you can basically count each year a depreciation loss of 20,000 euro. That doesn't mean that 20,000 euro leave the company each year. But from an accounting perspective, the loss is there in order to account for the loss of value of the assets that was purchased beforehand. So when we look at the book value after 3 years, that would only be 40,000. After 5 years, accordingly, which makes sense, the book value is 0 because it's been completely depreciated. But that doesn't necessarily, or not at all, which is often the case, it doesn't reflect what actually happens in the market. That's the market value or the salvage value. Let's say, for example, that you can easily sell the truck, which has been maintained well, it's in good shape, can easily be sold for 40,000 euro. Then if we go back to our balance sheet income statement, what would happen is, number one, here we have the book value was 0 already. So when we look at, for example, where is it? Property, plant, and equipment. In this case, it would be equipment, which is grouped together here. That was already 0. So there's actually no effect on the balance sheet. But because the book value was 0, and at the same time we sold it for 40,000 euro, the income statement is affected. But because it is not part of the normal business of Daimler, or for they would provide logistics, and that's their revenue. So that would be the normal revenue. But a revenue from selling a truck, that's not part of the normal business. And accordingly, it would be mentioned somewhere at the bottom. In terms of extraordinary items, it would be extraordinary income in this case. And that is the difference between the 4.3 billion, and the 4.0 billion of net income. I'll go back down. So the difference would be here an extraordinary income or a loss, depending on what the case is. I mean, it may also happen that an asset loses value very quickly and it can't actually be sold at, let's say, at book value. For example, if you have a very specialized manufacturer who basically designed and purchased a very specific machine, and then the product that would be manufactured with this machine is just not well sought after in the market. So the company tries to sell, but because it's very special and the product is not desired in the market, they can't sell it. Accordingly, it would be an extraordinary loss if they sell it below book value. The other example is, and that's what I mentioned earlier as well regarding goodwill. A company purchases another company with net assets of 2 million euro. So this is book value. Net asset means you have total assets, you reduce it by the liability of a company, and basically you end up with the net assets, 2 million euro. But the company paid 8 million euro, which is quite often the case. And that is because instead of looking at the book value of a company, you look at the market value and the kind of revenues that a company can generate for you. And so the difference here would not be an extraordinary income or loss. The difference would be goodwill. So basically, whenever you see goodwill in a balance sheet, it refers to the fact that a company has purchased another company and paid more than the book value of this entity. Okay? And it's just not in the income statement, it's mentioned in the balance sheet as an asset. Now, and how do we connect the two of them? Because when we look at the balance sheet, I'll go quickly one step up again, there's only one connecting point between the balance sheet and the income statement, and that is at the end of the year, the net income is basically transferred into the balance sheet as retained earnings here at the bottom as stockholders' equity, reduced by potential dividends to be paid out. Because when you have net income of 4 billion, for example, you can pay 2 billion of dividends and 2 billion would be retained earnings. And that is the only connecting point from the income statement to the balance sheet. Now we have the cash flow statement. And here we have a connecting point. And I'm using the indirect method starting from income statement. And there's also a direct method, but it's more complex and it's also in practice not used very often. As mentioned earlier, the income statement is based on an accrual basis, or was prepared on an accrual basis. But as mentioned as well, the cash flow does not necessarily happen when an income, or for example, is lodged in the accounting system. Let me give you an example, or two actually. We have accounts receivable and accounts payable. An accounts receivable is basically when a company makes a sale but does not yet collect the cash. This sale would be in the income statement, so it would be a net earning. But it is actually not money that's in the company just yet. Because, for example, and we talk about Daimler again, if you sell a car, but then you give the customer 30 days to settle the money, the debt. And that would be an account receivable. Versus an account payable is if you have to pay something in the future. So Daimler has a supplier which supplies lights, and they have a target of 90 days. So for 90 days, this let's say a transaction would be accounted for in the income statement as cost of goods sold, but the cash has not left the company. And when we talk about the cash flow, what happens, or what happened also when I was at university, for example, people would be looking at, when it was about the cash flow calculation, they would be looking at, let's say, formulas of delta X, delta Y, and the increase and the decrease, because the formula, and we'll look at that in a second, has a few aspects about it. But what I would also or always like to focus on is actually the fact that instead of looking at the formula, we should always try to think what happens with the business when we look at these financial accounts, when we look at the balance sheet or the cash flow. For example, we talked about the accounts receivable. And if that increases, does the cash flow increase? Let's think about this. We have accounts receivable, which means that we will receive money in the future. It has been accounted for in the income statement. So we will receive money in the future, and we now, from today onwards, or from last year onwards to today, that money, that amount has increased. What does it mean for the cash flow? I'll just solve this here. Basically, it has a negative cash flow effect because we have more money that has yet to be received. So although in the income statement we may have more sales because of this, we have not collected the cash. And that's a problem for the cash flow statement, as the name says. And at the same time, for example, if you have the increase in accounts payable, you owe more debt to people. You have to pay more people more money. But that means that you have to retain, or you have managed to retain more money in-house. And that's positive for your cash flow because you have more cash available. And here again, one of these aspects where the question would come up, is it good or bad? And again, it depends on the case at hand. For example, if it's good to keep the money in-house, well, for some companies, let's say it's good to keep the money in-house because Daimler could say, hey, we want to have the cash available, so we have long payment targets. And it's a sign of market power when companies can do that. However, if you have a business that is in the process of going bankrupt even, and then the company manages to keep that cash in-house, that's possibly due to the fact that they simply cannot pay. And then, obviously, it's not a good aspect that you keep the money in-house, and instead it's negative. All right. Then I prepared a small survey, and I hope that you can all log in real quick. I'm going to that screen now. If you could go to slido.com and enter the following code. By the way, I still hope you're all with me here. It's kind of weird talking to myself. All right. All right, so I see that there are responses. So the question, then I'll just fill this up with a bit more info here. Now we have looked at the three statements. Now the question is, why do we even have different statements? Who cares about the income statement more? Who cares about the cash flow statement more? All right, so here we have investors, cash flow. That's very good, of course. Any idea about who specifically cares about income statement in the balance sheet? All right. Good, we have a few answers. And now this, there we go, the tax office as well, very good. And yeah, so we have definitely the normal stakeholders, and those are investors, banks, and the government. So when we look at the balance sheet and the income statement, that represents, in a sense, because it's accrual accounting, it represents how well the company is doing in terms of sustaining itself. Because as mentioned, when you have depreciation, for example, that is deducted automatically because it shows an average loss, let's say, of assets. So the income statement is very important for banks, for example, because they want to know that the business they are financing is sustainable at the moment. And the balance sheet is also important for the banks because when they take a loan, or when they give a loan, then what happens, of course, is that they want to know what kind of assets can secure this loan. And this refers back to what I mentioned earlier about a very specialized machine, for example, which cannot be sold in the market because nobody else is interested in it, versus a truck to transport something. Anybody can use it. It's very difficult, very easy to value this truck. So they like these kind of assets. And they like a stable return. And then, of course, the tax office, and that's very correct, is interested in the income statement as well, because that's going to determine the taxable basis of the company. And obviously, corporate returns or income taxes are a very important part of each country in the world. Now, investors are a tricky one, but investors care about cash. Investors don't care as much about just the accounting income as they care about the generation of cash of a business. And that is because while, of course, it is important that the company has an accounting return in some way, the cash that's generated and which the investors can subsequently extract from any business, that is more important to them. So I hope that kind of wraps up that question. Then going back to our slide here, I would hope that we could do a small calculation because in the end, I mean, we're doing finance here. You can barely go without any kind of calculation whatsoever. And basically, we will do a cash flow from assets calculation. Excuse me. And cash flow from assets basically is what we just discussed, except that the financing aspect is taken out. And I've chosen this one because often when it's about evaluation of an asset or a company or a project, the financing part is a simple management decision, which is not necessarily directly connected to the assets or the project itself. And so when we look at these numbers, and I will give you just a couple of minutes. Now it's 8:03. I would say 7 minutes. You can just take a look at the numbers provided here, and then we'll see if we can find out what the cash flow from assets here is. And I left the formula there to be clear that because this is not about memorizing anything. This is about applying logically a case to our example. And please do send questions if you have any. I'm always happy to help. And yes, I just saw the question. You will have the slides at the end. I'll send them out. So I just saw a few comments. Just to be clear, I mean, there's a bit more time, but I just want to make sure that we're on the same page here. The cash flow from assets is the sum of the operating cash flow and the net capital spending and the change in net working capital. The only thing that, well, not the only thing, but one thing that has to be figured out is if net capital spending is positive or negative, and does it improve or does it reduce the cash flow, for example? These kind of questions are the key ones here. Oh yes, NWC is net working capital. Sorry if I've missed that earlier. It's basically regarding the current accounts. All right, I guess we can, unless any more questions. No, not at the moment. Okay, so the solution is here. I'm not sure if everybody had the chance to work this out. Basically, what we can say is, as mentioned, or I mentioned the formula, the operating cash flow is the EBIT, the earnings before interest and tax, plus depreciation and minus taxes. And again, the idea is that depreciation is an expense that is lodged in the income statement, but not actually any cash outflow. And so it has to be added back into the cash flow. Taxes, however, I mean, as the name says, earnings before interest and taxes. So taxes still have to be paid, and these are a cash outflow, and accordingly, they have to be deducted. Net capital spending, and that was mentioned earlier, is the net fixed assets, or the ending net fixed assets minus the beginning net fixed assets plus depreciation. And here again, something that I noticed, it helped me at least, maybe it'll help you as well. I always prefer to kind of think about what happened instead of looking at the formula, because ending net fixed assets minus beginning, and then you have multiple of these instances when you also have to look at the net working capital. So instead of looking at that, when we think about net capital spending, if, for example, the net fixed assets increase, that obviously means that capital has been spent in order to purchase an asset. Hence, any increase reduces the cash flow. Sorry. And because depreciation is also affected here when it comes to the fixed assets, it has to be added back up. And when it comes to the change in net working capital, and I apologize if I didn't make that clear earlier, again, it's about the ending minus the beginning, and that is the same principle. If money has been spent in order to accumulate assets, that means that money has left or has been used, and accordingly, it reduces the cash flow. And so as a result, you have the operating cash flow, which is one part of 2,100. And then you have the net capital spending, which is 700, and the changes in net working capital of 600. But because both are positive, this has to reduce the cash flow from assets. Again, because both the fixed assets as well as working capital has been increased, this reduces the cash flow because the cash is used. Hence, the cash flow is only, let's say, $800. And when I first came across this calculation, I was wondering a little bit why depreciation is considered twice here, because, I mean, it seems like, at least it seemed to me, that to add back up the depreciation would be enough. The reason that depreciation is considered twice is basically that it affects both the income and the balance sheet in a sense. As mentioned, the income statement definitely it is a cost, it's an expense. But also when we look at the fixed assets, they increased by 300. But during the year, well, so let's say one would assume the difference is only 300. But in effect, because the depreciation expense was there as well, it must mean that people spend 700, on replenishing basically the fixed assets in order to reach the improvement of 300. And again, because the difference of 300 plus depreciation have to be both considered here. Okay, so now we have basically connected the income statement and the balance sheet with the cash flow statement, and we have at least partially calculated and found a way to value the cash flow of a company. I wanted to also make a brief detour to the stock exchange, just because it's a very important aspect of our daily lives, and because there's also a very interesting case that recently developed. I'm not sure if you're all following the stock exchange regularly, not at all. But you may have noticed that there was quite a bit of discussion about Daimler and Tesla and the valuation, especially of Tesla, which has increased significantly in the last, let's say, 3-4 months. And so when we see this kind of overview, what we should focus on is not the price of a stock. It doesn't matter at all that Tesla has a valuation, or a share price of $750 versus Daimler only 42. What matters is the market capitalization, and that's the value of all shares in circulation combined. And that is insane to me, is you can see here that Tesla, who sells a fraction of the cars of Daimler, has a market capitalization 3 times as high. And the reason I'm saying this, or not only the reasons I'm saying this, but you can also look at the PE ratio, for example. Daimler has a PE ratio of 11, which basically means that Daimler has to earn the last year's income, or profit rather, 11 times in order to get to the market capitalization. So in 11 years, Daimler would have made up what the shares are worth. Now, let's quickly look at the net income. So Daimler, as mentioned, has a net income of 4 million in the most recent accounting period. The reason that Tesla doesn't even have a price earnings ratio is because it actually had negative income. So while this makes it even more insane about this valuation, because you have a company that has a net income of 4 million and they're only worth 11 times that. This company here makes a loss and is still worth 3 times that amount of the comparable. So, and that's where I mentioned that the investors sometimes care less about income statement and more about cash flow. And here what is mentioned is the cash flow, the free cash flow, which is basically, if we go back real quick, which is mentioned here, if we take the cash flow from operations, or cash from operations, which is 25 million, and we reduce the cash from investing, basically the free cash flow of this company would be 10,971,000. So that's the free cash flow. But basically, because there's a free cash flow and there's a very positive development overall here, people think, or people value Tesla higher than Daimler, because Daimler's cash flow is, as you can all see, quite atrocious. And I'm not going to say that this justifies the valuation of Tesla, but it is something to think about. And generally, I always think the stock exchange is quite interesting. So I thought this rather recent example might also be of interest to you. Okay, now we have established what a cash flow is and how we can potentially get there. So how do we get from there to valuing any kind of project or asset or company? And a key aspect of that is the time value of money. And basically, the time value of money means that a euro today or any currency is worth more than a euro later. And the discount rate is the rate on an annual basis at which each cash flow in the future would lose value. And I've originally decided to have a Slido question here again, but I kind of decided against that. So you can disregard that. The determinants of the time value of money, and by definition then also the discount rate, there are three different ones. One could consider the inflation, but unfortunately it's not sufficient, because inflation might be 1 or 2%, but that is the absolute minimum, but it's not enough to kind of even begin to justify a discount rate. Instead, what people often look at is the cost of capital, and that is related to a concept called the weighted average cost of capital for companies. And basically, there you can look at, for example, the cost of debt, which would be simply the interest rate that companies pay on their loans, or alternatively, and that is something that is more important in terms of when you, for example, think about your own work in junior enterprises, when you are asked by a company to kind of come up with a project return on investment. And there you talk about alternative investment opportunities. For example, a tech company may not consider a project worth investing in if the return on investment is only 10%, because tech companies need to grow quickly. Accordingly, each project needs to be highly valuable, and the returns must be very high, maybe 20, 30, or 40%. But a steel producer who is in a very conservative business, who has high asset values, they would look at a return on investment of 15% and would definitely take it, because they're not used to this kind of stuff. So it always depends. It's always subjective again. And when we talk about a project, we should always think about what kind of cash flows should we actually include. And the key word here is incremental cash flows. That means only cash flows that will occur or will not occur if we do go forward with this project. And that can also be a consideration to have just part cash flows. I could think of an example where you have an IT software, and what will happen is not only that you can, for example, say, well, we will save our people, we will save time. That, obviously, if you have a software and the processes are confirmed or improved, then you save time of the people. But not only is the direct cost of the people reduced, but those people can also focus on other projects, which are in turn adding value to the company. Based on that, you would consider, okay, we can obviously save HR expenses of X amount, but these people can also add value to other projects. So that could be an incremental beneficial cash flow. And then we have just the general examples, some things that should always be considered. And I will just briefly go through them. There are, for example, sunk costs, that are costs that have accrued in the past. And as the name says, sunk, it's basically at the bottom of the ocean. They happened, they are done, and they're not to be, you can't change them. Such a cost would not be considered an incremental cash flow because it's been done in the past. So this doesn't matter. For example, if you think about purchasing a new laptop, if you have purchased a laptop 1 year ago for 1,000 euro. You shouldn't think about that at all in terms of deciding whether you want a new laptop, because that cost you can't recover. The only consideration would be what the new laptop in the future would be to you. At the same time, you have opportunity costs. And that is a cost of lost options. For example, you want to rent out a warehouse, and the warehouse can only be rented out once. And if you rented it out, for example, you couldn't use it anymore to build your own factory in there. And the opportunity cost of renting it out is the revenue you could create if you had your own factory in there, for example. And the side effect I mentioned earlier, then you also have changes in net working capital, which is often related to manufacturing projects. So if you want to add a new product line, then not only do you have to kind of consider the cash flows or the investment of a new machine, but you also have to think about the inventory and other working capital. And then, of course, you have financing costs and taxes as well. All right. When we then have figured out which kind of cash flows we want to include on our calculation, then we need to measure the return of this project. And there are different measurements. All have their own strengths and weaknesses, and we'll go through them a little bit. The first ones are fairly straightforward, so I'll just mention them here. We have the payback rule, and I mean, it's fairly straightforward. Basically, you count or you calculate the years that it takes until you have the money back. It is not a very sophisticated measure, but people often like to see this because it's a quick and easy and understandable way. So even when we did the project in Sri Lanka, it was something that we always consider, just because even investors that may be sophisticated and understand complex business processes, even those people are always interested in seeing just simple, plain, and easily understandable numbers. And then you have the discounted payback, which is basically the same, only taking into account the time value of money and the discount rate. And as you can imagine, a discounted payback period will always be longer than the normal payback rule, because future cash flows are not as valuable as cash flows today. Then we have the profitability index and the ROI, and the internal rate of return, the IRR, and the NPV, which I will go through now. So the return on investment or the profitability index, that's also a fairly straightforward calculation. You basically have the net profit and the cost of an investment and express that as a percentage. So if you have, let's say, 10 cash flows of 100,000 and the investment is 900,000, you basically, although it's not entirely correct, you basically have a return on investment of 10% or 11, I think. But more importantly, or the main point here, is the net present value. And the formula, I put it down just because the formula is always important. But again, I would focus on what it actually stands for instead of trying to figure out what it means, mathematically speaking. The net present value is the sum of all future cash flows generated from an asset by applying the discount rate in order to reduce the value of cash flows further in the future. So, for example, when we look at a discount rate, and these are not values, but it's a factor. When you have a discount rate of 10%, each year a cash flow will lose value. And so by year 4, and that's fairly near in the future, you already have a factor of 68 or 0.68, which means that each euro revenue only adds 68 cents to the net present value. And that's a very powerful force if you think about it in the big picture. Then we have the internal rate of return. It's basically used also. It's not, and it's very clear. The rate, so the ROI, the return on investment, is a simple calculation. The internal rate of return, which can easily be mixed up, is a different one, because the internal rate of return also takes into account the time value of money, basically. And what happens here is the NPV needs to be set to 0. And because of the formula, it's a trial and error process, but fortunately, it can be calculated with financial calculators or Excel. All right. Can I just ask for a comment if it has been clear what I mentioned about the net present value? I will just repeat it again, just to be on the safe side. We have year 1, and each year, so we have year 1, 2, and 3, and 4. Each year, the cash flow from that specific year, from a further year, will be reduced by 10%. And so we have the factors here. And that means that in the future, cash flows are less valuable. And cash flow means whatever cash flows have been generated from an asset, and that means obviously income minus cost. All right. Just go back here real quick. Okay. Now, can we just go to Slido real quick for one last question? Oh, yeah. Based on the information provided, which one do you think is the best measurement of a project, and why? Obviously, I've mentioned a few things, but maybe you have some other aspects of what would constitute a good measurement. All right, NPV. Yeah, very good. Okay, possibly I've given some of it away, but these are very good answers, of course. Yes, and it's very correct. The risk, yes, the risk as well. Very good. So we have the point that it's the NPV because it's considered the time value of money and all the cash flows and the risk, and that is very correct. But as mentioned, very correct, very good. Only one thing that I would add from my side is simply the fact that it provides a fixed euro or US dollar or whatever currency value. When you look at the ROI or the IRR, it's nice to know, okay, we have maybe a 20% IRR or an ROI of 25%. But what does it mean? People like to see, okay, you know what, I'm investing 500,000 euro. What do I get back? What is the value? And if the net present value at that point, and that's a net, right? So already the investment has been deducted. So if on a 500,000 investment, you have a net present value of 200,000, all right, we'll take it. That's my positive value of the decision that I make today. So that's why people like it. And obviously what you mentioned earlier about the risk, about the time value of money, that is very correct as well. Okay, so I would try to have one more calculation, which is the project return. And here we'll think about a rather simple case, at least theoretically speaking. A new restaurant built or to be built and operated has the following cash flows for a project period of 8 years. And the upfront investment is 1 million, as you can see. The costs in the first 3 years are 310,000, just because of some additional marketing costs that you need in the beginning. And the costs in year 4 through 8 are 300,000 each. And we'll talk about the revenues, or we'll think about the revenues starting at 450,000 per year. But instead of a fixed change, we'll talk about annual growth rate of 5%. And our required return is 12%. With that knowledge, I would hope that we can find out what the IR, sorry, not what the IR is, but what the NPV is, and what decisions should be made regarding this project. Now, And obviously, well, in the header, I haven't said it, but if you could use Excel for that, I'm not sure if all of you or most of you are sitting in front of a laptop or a mobile phone. If you don't have Excel with you, then it's not that easy. I didn't account for that, to be honest. But let's see. Or let's take around 10 minutes, 12 minutes. And I will every once in a while check the chat in order to see if there are any questions. Yeah. And we'll talk about the IRR after that. Just seeing one question. The number of lost value per year, basically. That's the required rate of return. It's 12% here. So in the example I mentioned earlier, it was 10% on the slides. I'll just go back for a second. Here, this was 10%, but now we are talking about a 12% required rate of return. And just to be clear, I'm not sure if I made this clear enough. The required rate of return, it is the same thing as the discount rate, because if you need a discount, if you need a return of 12%, then by definition the discount rate is that amount, because that's going to be the value lost that you can accept, basically. All right, 2 questions. Yes, so in this example, the cash flow is revenues minus costs indeed. Which formula can be used here for the calculation? You can't just use the standard NPV formula. So so if I understand the question correctly, the standard NPV formula would be this one. And of course, in Excel, you wouldn't use it. Now, maybe you already know something that others may not. You can use there is a formula that you can use in Excel, but otherwise you can also just find out the annual cash flow and the value of each cash flow, and individually date them back, so to speak, or bring them to the present, and then sum them up. That's just a small hint, let's say. I would say just 2 more minutes, and then we can discuss. If anybody has, okay, there's already an answer. Very good. Thanks, Tony, by the way. All right, and 78,000. Very good. Both very close to each other. Yeah, all right, I think then we can move on and we'll check the results. So we have 77,000 from Tony, and Anton mentioned 78,000. I'll just go into my project calculation real quick. And indeed, 78,000 is very correct. Well done, of course. And so this is obviously it's a basic example, but we'll just go through the numbers really quickly here. And what we have is the revenues, as mentioned, factor of 1.5 just drawn out. So it would remain the same. Yes, it does. And then we have the costs here, which means the cash flows are as follows. And when we look at the formula, for example, for year 5, and this is something small that some people may intuitively do already, but instead of when you do a cash flow statement or projection over the years, instead of putting year 1, sometimes what you can better do is just put the 1 and put maybe the year over here, because then you can in the formula already put basically the year in there and drag it all out, and it wouldn't change, right? So it's very straightforward. Here's the cash flow, 1 plus the discount rate on the side, makes it 1.12, and then times 5, or whatever you call this sign mathematically, I'm not sure in English. But basically, then you have the factor here. And this is what I mentioned earlier. This effect of the time value of money is a very important concept, because if you think about it, after only 8 years, and that's for let's say a business, not a long time. After 8 years, the cash flow has lost. Let's take a quick look. After 8 years, the cash flow has lost 60% of its value. So this is very important to keep in mind when thinking of projects that are maybe very profitable in the long run, but the IRR is often, or the NPV is often heavily negatively affected if these positive returns and cash flows are coming very late. Okay, and what I meant, what was made clear mathematically earlier, is that the IRR is where the NPV is 0. And so let's just quickly try this. And before I forget, there is a net present value formula, and let me just look at the chat. Leah mentioned it, can't use the standard NPV formula. Maybe she knew that formula. You can confirm if you like. But indeed, there is a small difference. The net present formula is a bit more complex than just summing up the cash flows. So this is technically the correct amount here. The NPV formula is slightly different, and I mean, we should keep in mind it's not a material difference. So if it's really about making a decision of a project, both options work. The reason that the NPV formula is slightly different is because of the timing of payments. And without going into too much detail, there is an ex-NPV formula, where you can also even mention the date on the timing of the payments. But I don't think it's very important and material to know this kind of stuff right now. So that's the NPV formula, and there's also an IRR formula. Again, just mentioning all the cash flows, and it comes automatically. And to test our mathematical hypothesis, we can just quickly take a look. If we do the 13.88 IRR, I checked that earlier, that's why I put the 4 here. It basically is 0. And so this assumption holds true, that the IRR basically is the return where the NPV is 0. All right. Were there any other questions? No, not at the moment. Okay. Then I think it's already the last main point when it comes to project investment decisions. One thing that I just wanted to mention on the side, people always talk about the break even. And even here, and this is in line with what I mentioned earlier about accounting not always being just straightforward and clear, even the break even can have a different meaning. And we can talk about the cash break even, which is basically the sales volume or revenue at which the operating cash flow is 0. You can also talk about the accounting break even, where the net income is 0, and that is a higher sales volume because the accounting break even takes into account the expenses of depreciation. And then in addition, when you add the time value of money in there, then that's when you have the financial break even. And so the sales volume at which the net present value is higher, is 0, is even higher than that. That is just a side note, because as mentioned, when people talk about break even, it's an important discussion always, but it's also important to be clear what kind of break even we are talking about. All right. Now, I'm just looking at the time. It is 8:47 now. I don't want to keep all of you for too long. And unfortunately, I also didn't have the time because, my day-to-day job was a bit too complex in the past few days to really focus on this. I will talk about this, but if also some of you are now kind of ready to go, before I do this, I just wanted to mention real quick that I basically wrap this up for the time being. I'm not sure how I can share my video here. Okay, it doesn't matter. Anyway, so then let me do it this way. Before I go into corporate valuation, I would like to thank you all for attending this webinar. If a good feedback culture is very important, And if you are in a junior enterprise that cherishes and works with a good feedback culture, then please be happy about that and try to carry it as far as you can. That being said, it doesn't happen everywhere. But I am a huge fan of feedback. I know that such a webinar, and it's my first one, as I mentioned earlier, it will not be perfect. I'm happy to have your feedback. Obviously, I'm glad if some of it is positive. But please give us constructive feedback. Let us know what is good, what is bad, and so that not only, let's say, my workshops in the future can be better, but maybe even for organizational things with junior enterprise, anything that can be improved, we are always happy to hear that. And if you're further interested in some review of a corporate valuation, then please just stay on for a few more minutes. Otherwise, thanks a lot for your attendance. And okay, so corporate valuation. We are talking about basically the M&A business. And the methodology is, which is good for us, I guess, because we've gone through it, is pretty much the same. So in the corporate valuation, there are different models, and one is basically a market approach, where you talk about the market value. And that's not in the slides, but I'm just mentioning this. In the market approach, you have basically, let's say, the EBIT as an accounting standard, or the EBITDA. And as we had it earlier, the EBIT is the earnings before interest and tax. The EBITDA would be the earnings before interest, taxes, depreciation, and amortization. And that accounting, let's say, measurement basically tries to eliminate all the external factors. So as mentioned earlier, the financing, for example, of a company is a decision of the management, is not related to the operations of a firm. And so you take this EBIT or this EBITDA and you look at comparable transactions that happened in the past. And let's say in a certain industry, again, let's use the software industry, the recent transactions that occurred had a EBITDA or a transaction value of 5 times EBITDA on average. And so you take this 5 times ratio, and it's called a multiple, and you just apply it to your own company. You take your EBIT, multiply it by 5, and you have your corporate valuation done. Another approach is the accounting approach, and that is what we did earlier. You look at the discounted cash flow method, and that is the net present value in the end. And you kind of figure out what kind of cash flows your company generates. And let's say you project 3 to 5 years and take those cash flows. And then in the end, you only have to add what is called a terminal value. And the terminal value basically assumes, and they call it the going concern value, that, let's say, indefinitely, forever, the company continues to provide the same return on investment. And for that, you have the discount rate, which is the WACC, and that's the weighted average cost of capital. And I can briefly go back to the beginning of our slides and talk about, let me just do it that way, and talk about Daimler. When we have the WACC, we have the weighted average cost of capital. And weighted means you take the weight of debt and equity. So for example, here the debt would have a weight of around 0.7, I believe. And the equity would have a weight of around 0.3. So the weights together have to be 1. And debt, as mentioned, the cost of debt can be fairly easy to identify. It's just the average rate of interest that you pay on your debt. And for corporates, especially during today's times, it's often very low. So the cost of debt would be maybe 3%, 4% these days. But the cost of equity is generally assumed to be quite higher. And I don't want to go into detail too much today because it's an entire new concept. But if you would like to look it up, then it's called the capital asset pricing model, where you assume that the equity people, the equity holders, the stockholders, they require higher return. And that return is often assumed to be in the range of 12 to 15%. The way you reach this required return is by taking a look at the average return of the stock of basically listed companies over the past 10 years. And then I'm going back to my example from the stock exchange market. Let's, for example, assume that stocks have in the past resulted in a 10% return, and that's actually quite close to the truth, I believe. So if stocks on average have resulted in a return of 10% annually, then the only thing that you have to add is the beta, which is mentioned here. And the beta, 1.59, means that if the stock exchange market generally moves by 1%, then Daimler, the share, moves by 1.59%. Both ways. So it's an indicator of risk. It's not good, not bad. It's an indicator of risk and fluctuation. So if the average return of the stock exchange market is 10%, then the cost of equity for Daimler would be 15.9%. And so what you basically do is you take your weight, and that's, in this case, it was 0.3. That's the weight of equity times 15, and I'm doing this live, so probably mistakes will happen. So we have 0.477, so that's 4.77%. Then you have your the cost of debt, and that's percent is the average cost of debt.
Christian?
Yeah.
Would you mind to share your screen again, please?
Oh, it's not sharing anymore?
No.
Oh, sorry, my bad.
Thank you.
No worries at all. It does not. All right, I think now. Yeah. Okay, I will do this in Excel. So we talked about Daimler. We mentioned that the beta was 1.59 and the return is 10%. So the cost of equity would be 51%, 15 point, like this, times a weight of 0.3. So we have here the cost of equity is 4.77%. Then you have the debt, which costs Daimler maybe 3%, and this is an assumption, of course. And the weight is 0.7. So this aspect is 2% only, 2.1. So together you have the WACC of 6.87%. So basically, again, you take the weight, and the weight you take from the weight of equity versus liabilities, and that's roughly, let's say, 30% and 70%. So 64 divided by the total liabilities and stockholders, stockholder equity, and then 215 divided by 281. So that is the weight. And then you look at the cost. I assumed that each debt costs around 3% versus while the equity shareholders require a return of 15.9% because 10% is the average shareholder return, but the beta, and that you also couldn't see, I believe, is mentioned here, is 1.59, results in basically for each equity holder, it results in a required rate of return of 15.9%, but because the weight 0.3 is there as well, it's only 4.77, resulting in a total weighted average cost of capital of 6.87%. And basically that's what it is. You only have to then project the cash flows of the future and discount the cash flows by this weighted average cost of capital, and you almost have your corporate valuation. And again, this is a small snapshot because I didn't know how much time we would have, and it was also too busy to prepare this part. but I hope it provides an understanding and a start, because yeah, the weighted average cost of capital is certainly a very important aspect of corporate valuations. And I always just like to think that all the other information of the calculation models is always also basically available publicly. You just have to go to websites, to stock exchange websites like Yahoo. In this case, in German, it would be finanzen.net, which I use often, and they basically provide all the data and statistics that you need to provide, let's say, a basic valuation method by yourself. All right, and with that, I now reached officially the 1.5 hour mark. So once again, I hope it was interesting, and please, let me know how you found it. Feel free to connect on LinkedIn as well. I'm happy to connect there with all of you. And I hope you have a good evening from now on. Thank you very much. Oh, and if you have any questions, let me know right now. Uh-oh, corporate finance exam. Good luck. Like I said, thanks. Obviously appreciate it. That your messages are very nice, certainly. But really, I'm always open to feedback. Let me know. And then if there's any question, let me know as well, of course. All right, thanks. About not monetary aspects. Wait, what do you mean by that? Also, Tony, by the way, you can also unmute and we can just discuss. The value of customers. I believe that I would be an expert on that stuff, but because the value of customers, I mean, of course, the thing is, the metrics that are used to determine the value of a customer, those are the exact same things, right? So even when you have the average, yeah. But the thing is, in the end, when you, for example, talk about the lifetime value of a customer, it's the models use the same fundamentals. How to come to the value of each customer, that I would say is the team, or is the work of the marketing department, which would find out basically how likely somebody is to purchase your product and how quickly they change or not, how elastic the demand is. I believe that there you would really look at setting the value of each one. All right, and I will log off now. Thank you, everyone. Bye-bye.